Welcome all finance enthusiasts. Let us continue preparing you to pass the Securities Industry Essentials, or SIE, exam. In our previous video, we introduced you to bonds, a debt instrument. Now let us dive deeper into the various types of debt instruments. As you know, one method that corporations use to raise capital is by selling an ownership interest to investors, equities, or stocks. Corporations can also raise capital by issuing bonds, essentially borrowing money. Unlike shareholders, investors who buy bonds or lend money do not become part owners of the company. Instead, these investors become creditors. Essentially, think of purchasers of bonds as taking on the role of a bank by lending money to the issuer for a certain period. In return, the corporation agrees to pay these investors interest, as well as to repay the original amount of the loan when the bond matures. Although bonds are categorized based on the entity that issues them, all of these debt instruments have certain fundamental traits in common. This segment will examine specific details related to bonds that corporations, the U.S. government, municipalities, and other borrowers issue. Now, you all know that a bond is a contract between an issuer and an investor. The securities differ in their relative safety profiles and the tax status of their interest payments. Something to note is that a bond is a loan. Types of debt instruments: Treasury securities. According to the Securities Act of 1933, securities that the U.S. government or treasuries and any government agency issue are exempt from registration. Treasury securities are considered the safest type of fixed-income investment and are suitable for the most conservative investors. Since the securities are backed by the full faith and credit of the U.S. government, they carry virtually no credit risk. This no-default status serves as the benchmark against which the credit ratings of all other issuers are measured. The U.S. government issues securities to finance its operations. The securities may be divided into two major groups: 1, marketable, negotiable, and 2, non-marketable, non-negotiable. Treasury securities are considered marketable securities since they're traded in the secondary market after issuance. In contrast, U.S. savings bonds are considered non-negotiable since they're purchased from and redeemed back to the U.S. government. Of the two groups, marketable securities are much more likely to appear on the SIE examination. Marketable instruments include Treasury bills, Treasury notes, Treasury bonds, Treasury separate trading of registered interest and principal securities, also known as T-strips, Treasury inflation-protected securities, or TIPS, and Treasury cash management bills, or CMBs. From this point on, when the word treasuries is used, it will refer only to marketable or negotiable securities. The three most prevalent types of these marketable issues are T-bills, T-notes, and T-bonds. Let's begin our discussion with the interest-bearing Treasury securities and then move on to other instruments that are non-interest-bearing. Treasury notes, or T-notes, and Treasury bonds, or T-bonds. Treasury bonds and Treasury notes are interest-bearing securities that possess all the attributes of traditional fixed-income investments. Each pays a fixed rate of interest semi-annually, and investors receive the face value at maturity. Treasury notes have initial maturities ranging from 2 to 10 years, while Treasury bonds are issued with maturities of more than 10 years. T-notes and T-bonds are both issued in book entry or electronic form and in minimum denominations of $100. However, please note that most examples in this study manual will use a par value of $1,000. The interest received on T-notes and T-bonds is taxed at the federal level but is exempt from state and local taxation. The main reason for purchasing Treasury securities is the safety that accompanies a government-backed investment. Treasury inflation-protected securities, also known as TIPS. One of the primary concerns for bond investors is inflation. Since a bond investor may often need to wait years for the return of their principal, inflation, which is a rise in prevailing prices, will diminish the purchasing power of the returned funds. So, how can a Treasury investor protect herself? One answer may be to acquire protection by investing in Treasury inflation-protected securities, or TIPS. TIPS are interest-bearing, marketable securities. The rate of interest on TIPS is fixed. However, the principal amount on which that interest is paid may vary based on changes in the Consumer Price Index, or CPI. During periods of inflation, which is a rise in CPI, the principal value will increase. Conversely, if deflation occurs due to a decline in CPI, the principal value of the instrument will decrease, but not below $1,000. TIPS are issued in book entry form in $100 increments and are available in 5, 10, and 30-year terms. The interest received on TIPS is taxed at the federal level, but is exempt from state and local taxation. An investor purchased a 4% TIPS with an original principal value of $1,000. Due to inflation, if the principal is adjusted to $1,030, how much interest will she receive for her next semi-annual payment? TIPS pay a fixed rate of interest, but it's based on an inflation-adjusted principal. In this example, the 4% coupon rate is multiplied by the adjusted principal of $1,030, resulting in an annual interest amount of $41.20. However, the investor's next semi-annual payment is $20.60, which is $41.20 divided by 2. Non-interest-bearing securities, T-bonds, T-notes, and TIPS are all interest-bearing instruments. This next section describes the various forms of treasuries that are non-interest-bearing. These securities are issued at a discount and mature at face value. Treasury bills are short-term securities that mature in 1 year or less. Currently, an investor may purchase T-bills with maturities of 1 month, 3 months, 6 months, and 1 year. T-bills are issued in book entry form only and are sold in minimum denominations of $100 and in multiples of $100 thereafter. T-bills are always sold at a discount from their face value, and unlike Treasury bonds and notes, T-bills don't make semi-annual interest payments. The difference between a T-bill's purchase price and its face value at maturity represents the investor's interest. T-bills are quoted on a discounted yield basis, not as a percentage of their par value. The yield represents the percentage discount from the face value of the security. An example of a T-bill quotation is bid 1.12, asked 1.11, ask yield 1.13. Remember, due to the inverse relationship between price and yield, the higher the yield, the lower the price, and the lower the yield, the higher the price. Therefore, even though the bid, 1.12 discount yield, is numerically higher than the asked, 1.11 discount yield, the bid higher yield corresponds to a lower price. Along with the bid and asked quotation, the column titled Ask Yield signifies the bond or coupon equivalent yield. The bond equivalent yield allows investors to compare the yields available on T-bills with those available on notes, bonds, and other interest-bearing securities. The bond equivalent yield takes into account the fact that the interest being earned is on the amount invested, not on the face amount. As a result, a T-bill's bond equivalent yield is always greater than its discount yield. In the 1980s, several broker-dealers began stripping the interest payments and final principal payments from Treasury notes and bonds, and then repackaging and reselling them as zero-coupon bonds. Although these stripped securities were not issued by the Treasury, their cash flows were very secure since the underlying securities are direct obligations of the U.S. government. Subsequently, a group of dealers began issuing generic stripped securities referred to as Treasury receipts, or TRs. An important distinction is that Treasury receipts are backed by Treasury securities owned by the issuing broker-dealer. They're not directly backed by the U.S. Treasury. To facilitate the stripping of securities, the Treasury created its separate trading of registered interest and principal securities, or STRIPS program. Dealers can purchase T-notes and T-bonds, reselling the coupon and principal payments as zero coupons or discounted securities after requesting this treatment through a Federal Reserve Bank. The difference between an investor's purchase price and the bond's face value represents interest. STRIPS are backed by the full faith and credit of the U.S. Treasury and are quoted on a yield basis, not as a percentage of their par value. Cash management bills, or CMBs, are unscheduled short-term debt offerings used to smooth out Treasury cash flows. They are issued at a discount but mature at their face amount. The duration of CMBs may be as short as 1 day. U.S. Treasury securities auctions, the primary market. The government sells treasuries through auctions conducted by the U.S. Treasury. The frequency of these auctions varies depending on the securities being sold. Competitive versus non-competitive tenders. When treasury auctions are held, securities firms compete by submitting bids to buy treasuries through an automated system. These bids are referred to as competitive tenders since they specify the price and/or yield at which the firm is willing to buy the treasuries. Competitive bids are similar to limit orders to buy stock at a specific price but may not be filled. However, if an individual wants to purchase treasuries, they usually submit a non-competitive tender. Non-competitive bids are similar to market orders placed to buy stock, as they don't specify a price and are guaranteed to be filled. Non-competitive bids are filled first. However, bidders must agree to accept the yield and price determined by the auction. All winners of the auction will ultimately pay the lowest price of the accepted competitive tenders. This single-price auction process is referred to as a Dutch auction. Agency securities. Agency securities include debt instruments issued and/or guaranteed by federal agencies and government-sponsored enterprises, or GSEs. Although agency securities are not direct obligations of the U.S. government, their credit risk is still considered low. Investors are drawn to agency securities due to their perceived safety and the fact that their yields are slightly higher than the yields of corresponding U.S. Treasury securities. The overriding presumption is that since the federal government created these entities, it will not allow a default on their obligations. Therefore, most agency debt is highly rated, with many agency offerings maintaining AAA ratings. Also, as with U.S. Treasury securities, agency debt is issued in book entry form and quoted in fractions of 1/32 of a point. Federal agencies. As federal agencies are direct extensions of the United States government, the securities they issue or guarantee are backed by the full faith and credit of the U.S. government. This category includes the Government National Mortgage Association, also known as GNMA. Government-sponsored enterprises. Government-sponsored enterprises, or GSEs, are publicly chartered but privately owned organizations. Congress allowed for their creation to provide low-cost loans to certain segments of the population. The enterprise issues securities through a selling group of dealers, with the offerings proceeds provided to a bank or other lender. The bank then lends the money to individuals seeking financing, such as homeowners or farmers. Although GSE securities are not backed by the U.S. government, they are considered to have minimal default risk. Examples of GSEs include the Federal Farm Credit Banks, or FCBs, and the Federal Home Loan Banks, or FHLBs. The Federal Farm Credit Banks provide funds for three separate entities: banks for cooperatives, intermediate credit banks, and federal land banks. These organizations make agricultural loans to farmers. Interest received on these obligations is subject to federal tax but is exempt from state and local taxes. The 12 federal home loan banks help provide liquidity for savings and loan institutions that may need extra funds to meet seasonal demands for money. As with FFCB debt, interest received on these securities is subject to federal tax but is exempt from state and local taxes. Mortgage-backed securities. As the name implies, mortgage-backed securities are debt instruments secured by pools of home mortgages. The agencies that issue these securities include the Government National Mortgage Association, or GNMA, the Federal National Mortgage Association, or FNMA, and the Federal Home Loan Mortgage Corporation, or FHLMC, pass-through certificates. The most common security issued by government agencies is a mortgage-backed pass-through certificate. The simplest method of creating a pass-through certificate is for an agency to purchase a pool of mortgages with similar interest rates and maturities. Interests in the pool are then sold to investors as pass-through certificates. Each certificate represents an undivided interest in the pool, and the owners are entitled to share in the cash flow generated by the pooled mortgages. On a monthly basis, the homeowners in the pool make their mortgage payments, and after certain administrative charges are deducted, the bulk of these payments are passed through to investors each month. Each payment includes a portion of both interest and principal. The purpose of the Federal Home Loan Mortgage Corporation, or Freddie Mac, is to provide funds to federally insured savings institutions to finance new housing. Freddie Mac raises money for its operations by issuing mortgage-backed bonds, pass-through certificates, and guaranteed mortgage-backed certificates. These securities are not backed by the U.S. government. Instead, they're backed by other agencies and the mortgages purchased by Freddie Mac. Interest earned on Freddie Mac securities is subject to federal, state, and local tax, meaning it's fully taxable. The Federal National Mortgage Association, or Fannie Mae, raises money to buy Insured Federal Housing Administration, or FHA, Veterans Administration, or VA, and conventional residential mortgages from lenders such as banks and savings and loan associations. Rather than being backed by the U.S. government, Fannie Mae issues are backed by its authority to borrow from the U.S. Treasury. Interest earned on Fannie Mae securities is subject to federal, state, and local taxes, meaning it's fully taxable. Unlike Freddie Mac and Fannie Mae, the Government National Mortgage Association, or Ginnie Mae, is a wholly owned corporation operating within the U.S. Department of Housing and Urban Development. Ginnie Mae's purpose is to provide financing for residential housing. Although Ginnie Mae securities are explicitly backed by the full faith and credit of the U.S. government, any interest earned on them is subject to federal, state, and local taxes. Ginnie Mae issues mortgage-backed securities and participation certificates, but its most popular securities are modified pass-through certificates. A modified pass-through certificate is backed by a pool of FHA and/or VA residential mortgages. As the homeowners in the pool make their mortgage payments, consisting of principal and interest, a portion of those payments is passed through to the investors who purchase the certificates from Ginnie Mae. Ginnie Mae guarantees monthly payments to the owners of the certificates even if it has not collected them from the homeowners. The mortgages in the pool have maturities ranging from 25 to 30 years. However, due to prepayments, foreclosures, and refinancings, the average life of the pool tends to be much shorter, especially during periods of declining interest rates and the resulting prepayment risk. Prepayment risk. In addition to the inherent risks associated with many fixed-income investments, like interest rate, credit, and liquidity risk, mortgage-backed securities are subject to a special type of risk referred to as prepayment risk. This risk is tied to homeowners paying off their mortgages early. When interest rates fall, homeowners are incentivized to refinance and pay off their existing mortgages. This risk, along with others, will be described in more detail later in the series. Municipal bonds. Municipal bonds are issued by states, territories, and possessions of the United States, as well as by other political subdivisions like counties, cities, or school districts. Public agencies, such as authorities and commissions, also have the authority to issue municipal bonds. Unlike U.S. Treasury securities, these debt instruments carry some level of default risk, since municipal bonds are not backed by the federal government. For most investors, the primary advantage of municipal bonds is that the interest received is typically exempt from federal tax. Types of municipal bonds. There are primarily two types of municipal bonds: general obligation bonds, known as GOs, and revenue bonds. GO bonds may be issued to meet any and all needs of the issuer. In a sense, GO bonds are issued for general purposes. On the other hand, revenue bonds are typically issued to fund a specific project or facility, such as a bridge or toll road. For revenue bonds, the cash flows generated by the specific project, like tolls or usage fees, are used to repay bondholders. General obligation GO bonds. A general obligation bond is secured by the full faith, credit, and taxing power of the issuer. Therefore, only issuers that have the ability to levy and collect taxes may issue GO bonds. State or local governments are able to issue general obligation bonds based on their statutory or constitutional powers. However, prior to issuing general obligation bonds, issuers must obtain voter approval. Essentially, this voting requirement is due to the fact that taxpayer money is being used to pay debt service. Authority to issue. A statutory power is a law that is passed by a state or local government which allows for the issuance of securities. The constitutional powers to issue general obligation bonds are derived from the state constitution. These statutory and constitutional powers may also limit the amount of debt that an issuer is able to incur. In other words, a GO bond issuer may be subject to a debt ceiling. Backing. State general obligation bonds are usually secured by income tax, sales tax, and other taxes that are collected at the state level. For local jurisdictions such as counties and cities, the most common source of tax revenue comes from levies on real property, also known as ad valorem tax. School taxes are also assessed at the local level and are normally a significant portion of a person's real estate tax assessment. In addition, other non-tax revenue like parking fees, park and recreational expenses, and licensing fees may be used to pay the debt service on GO bonds. Revenue bonds. Revenue bonds are issued for either projects or enterprise financings in which the issuer pledges to repay the bondholders using the revenues generated by the project or facility. Issuers of revenue bonds may be authorized political entities such as state or local governments, an authority like the Port Authority of New York and New Jersey, or a commission created to issue bonds for the purpose of building and operating a project. Revenue bonds can be used to finance airports, water and sewer systems, bridges, turnpikes, hospitals, and many other facilities. Concessions, tolls, and user fees associated with these facilities are used to make interest and principal payments on the bonds. Revenue bonds are generally considered riskier than GO bonds since the generated revenues may prove to be unreliable or insufficient to fund debt service. Another source of revenue originates from rental or lease payments. For example, a state may create a nonprofit authority to issue revenue bonds to build a school. The local government that uses the school will lease the facility from the authority, and the lease payments will be used by the issuer to pay interest and principal. Revenue bonds may be issued when voter approval for general obligation bonds cannot be obtained. Additionally, revenue bonds may be issued to finance capital projects when statutory or constitutional debt limitations prevent a municipality from issuing general obligation bonds. Types of revenue bonds. Revenue bonds are generally characterized by the project they finance or by the sources backing them. The following list represents some of the more common types of revenue issues. Housing revenue bonds. Housing bonds are issued by state or local housing finance agencies to help fund single-family or multifamily housing, typically aimed at low or moderate income families. In some cases, the proceeds from the bond offering are lent to real estate developers constructing the property. Housing revenue bonds. Housing bonds are issued by state or local housing finance agencies to help fund single-family or multifamily housing, typically aimed at low or moderate income families. In some cases, the proceeds from the bond offering are lent to real estate developers constructing the property. Dormitory bonds are issued to build housing for students at public universities and are repaid from a portion of students' tuition payments. Healthcare bonds are used to construct nonprofit hospitals and healthcare facilities. Utility bonds are issued to finance gas, water, sewer, and electric power systems owned by a governmental unit. These bonds are usually backed by the user fees charged to customers. Transportation bonds. Transportation bonds finance projects such as bridges, tunnels, toll roads, airports, and transit systems. User fees, like tolls, are used to pay the debt service on these bonds. Special tax bonds. Special tax bonds are backed by specific taxes such as taxes on tobacco, gasoline, or hotel/motel stays for a particular project or purpose, excluding ad valorem or property taxes. For example, highway bonds payable from an excise tax on gasoline are considered special tax bonds. Special assessment bonds. Special assessment bonds are payable solely from a specific charge on those who directly benefit from the facilities. Examples include bonds issued to develop or improve water and sewer systems, sidewalks, and streets. Moral obligation bonds. The revenues of a project primarily secure moral obligation bonds. However, if revenues are insufficient to meet debt service requirements, the state or a state agency has a moral obligation but not a legal requirement to provide the needed funds. Legislative approval from the state government must be obtained before issuing bonds as moral obligation bonds. Lease rental bonds. Lease rental offerings involve one municipal entity leasing a facility from another. For example, a state building authority may issue bonds to build a college dormitory and then lease the dorm to the college. The bonds issued by the building authority will be repaid from the revenues generated through lease payments from the college. Private activity bonds. If more than 10% of the bond's proceeds are used to finance a project for a private entity, like a corporation or professional sports team, and if more than 10% of the bond's proceeds are secured by property used in the private entity's business, these bonds are referred to as private activity bonds. Industrial development bonds, or IDBs, are a type of private activity bond issued by a municipality and secured by a lease agreement with a corporation. The purpose of the offering is, well, to build a facility for a private company. The credit rating of the security is based on the corporation's ability to make lease payments, as the municipality does not back the bonds. Taxable municipal bonds. In certain cases, a municipality may not be able to issue bonds exempt from federal income tax. This may occur when the bonds are issued to finance projects that do not provide a significant benefit to the general public. Examples of situations where a bond may lose its tax exemption include 1. An offering in which proceeds are used to build a sports facility or certain types of housing, or 2. An offering intended to enable an issuer to borrow funds to replenish unfunded pension liabilities. Double-barreled bonds. Double-barreled bonds are backed by a specific revenue source other than property taxes, as well as the full faith and credit of an issuer with taxing authority, also known as a GO issuer. Essentially, debt service on the bonds will be paid through a combination of tax dollars and revenue dollars from the project being constructed. Join us for a follow-up video continuation where we will discuss municipal notes. As always, please like this video so others can see it.